All right, welcome in everybody. Happy Wednesday, AI Circle Wednesday. What is it? Middle of August, which is crazy to believe. Thank you guys for joining us. As always, we'll give everyone a couple seconds to hop on and let YouTube catch up to us here. If you're new to the channel or the platform, this is the AI Circle put on by iFlip. We are a investment platform. More specifically, we use AI to manage risks. So we're going to talk a little bit about what the AI has been doing recently. There's been a crazy last couple of weeks with a few dips and a lot of rallies, I guess. So with all that being said, though, it looks like we've got a handful of folks already in here. Let's welcome in Mr. Kelly Korshak. Kelly, how you doing?
I'm doing pretty okay, pretty well, pretty decent today. How are you, Lee?
Doing well. I was talking to someone the other day, and they said they're closing on a house or something in September. I'm like, oh, you got some time, and that could be 2 weeks away, which is just crazy to believe that we're almost into the fourth quarter of the year.
Just another month and a half.
Yeah. Well, cool. Well, as always, we do need to get our fun disclosures out of the way before Kelly or I say anything and get anyone in trouble. So, Kelly, you did it last time. I'll do it this time.
All right,
Maybe we'll keep trading
I'm
off.
still capable of reading.
I believe you are.
Here's the disclaimer, everybody. I'll read today. Flip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make buy and sell hold recommendations on any instruments. This presentation is for education only. Unique experience and past performance do not guarantee future results. All financial investments involve risk. You should speak to a CPA or financial rep in order to ensure that iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. And all that says, everybody, is that when you're on a platform like ours and you're receiving news from the same people that created the platform and worked for the company, that there's a potential conflict of interest, but there really isn't. This is here where the AI Circle is where I talk about the product and certain markets, and I'm not making recommendations. I like things, I hate things. I say that's for you to discern.
Absolutely.
Make your own choices on those things. So,
sure.
That being said, we're going to, I hope everybody can see a screen.
Yeah, give me 1 second, Kelly. So just the agenda's on the screen now. Jim said hi in the chat. So hello, Jim. Nice to see you back in here. Not really any announcements today. And I'm sure if you guys have been on here regularly, you've heard this plenty from me. But if you are still logging into your platform and getting that ID verification pop up, please take care of that. Reach out to me if you have any questions. You can also reach out to our support team at support@iflipinvest.com. Kelly's going to do his market update next. And then we actually have one very significant trade that the AI has made lately to talk about. And my guess would be that'll take up a lot of the conversation tonight. And then lastly, maybe the reason that everyone's here is for the Q&A and also the Amazon gift card giveaway. So if this is your first time, you can win a $25 Amazon gift card just for participating and asking a great question that is deemed to be our winner. So, Kelly, with all that being said, let me get your screen going and we will be off to the races. Go ahead, Kelly.
All right. We're going to start with a different screen today. Normally, I go through the markets, and we'll do that a little bit after we go through this. One of the most recent things, the most recent question that comes into iFlip that ultimately gets directed to me is, why weren't we long the S&P 500, the SPDR? For our company, the SPDR is the key component in almost every portfolio, balanced, aggressive, even conservative. We all have some SPDR in all of those portfolios, amongst all the others, SPY-I, SPY Plus, all of them. So Flip is run, and we create smartfolios largely along the lines of the way I've watched large money managers and actually worked for these kind of firms in my life. This is how they do it when they're involved in the equity space. They can maintain large positions in a very highly liquid platform that represents the S&P 500. What is that? Well, we all know it's the Spider. The Spider, there are other vehicles by Vanguard and others, but the Spider is the main vehicle for large money management firms to put on their risk. In other words, if you want to buy the market, yes, you could buy Apple and Amazon and United Health Services, etc., but you can also just buy the Spider. So fundamentally, the way a large money manager works is they create a portfolio generally composed of a small number of items depending on the size of the money management that we're doing. So if you're, say, $1 billion or less, you're going to have large capital allocations into the S&P 500 itself, the Spider. Literally, you might put 30 to 50% of your portfolio right into that. And then you'll let your traders trade the other 70 to 50% of the money in the individual stock issues. The reason we do that is so that we have the ability to maneuver in and out of the markets quickly and change the beta. The beta represents the exposure you have with your positions to the overall market. If your beta is 1, which the S&P 500 has a beta of 1, it means if the market goes up 10%, you're going to make 10%. If the market goes down 10%, you're going to lose 10%. And when we use these kind of methodologies, machine learning or algorithms, what we're trying to do is adjust your beta to be higher than 1 when the market is going up and lower than 1 when the market is going down. And I can tell you that generally we position our portfolios anything under aggressive to have betas that are marginally or much significantly below 1, which means the market goes down 10%. We don't want our customers to lose to 10. We want them to lose a fraction of that. So how do we do that? Well, first of all, it starts with the S&P 500. And it means that we can only really be invested in the S&P 500 when we feel the risk versus the reward mathematically through algorithms and machine learning is greater than 1 to 1. So a few weeks back, as you recall, the market was really moving higher on the S&P. We reached an all-time high right up in here. If you could see my mouse right up in this area. And I could tell you right there that that high price there that was achieved was about 565 on the S&P. Right there, 564 something. Call it 565 even. At 565, if I have to take my risk, the general algorithmic risk here is literally down to this line right here. That's the algorithmic risk. Now, we do have a machine learning component that is trying to find ways to maneuver before we get to this spot. But this is the drop dead spot here. And when the price of the S&P was at 565, and we were not in the market for some time, and the market had been moving up, it had moved up literally 6.5% since the time it achieved that price, we couldn't be in because it violated a rule for us. And one of that rules is, and you might have heard this, we're trying never to lose more than 10% off of all-time high wealth. That's one of the rules we have. And so therefore, our largest model, the S&P, has to maintain that rule. If our stop, where we would say, hey, we have to get out algorithmically, which is not all we do, was right here, that looks more like 495. That is a difference of 70 points. Now, if I take 70 points off of 565, we're over 10%. That's why we're not out, why we're not in the market. We weren't in the market here either. We weren't in the market here either. We weren't in the market even here, where we had a little low. However, since that time, the market did have a serious correction, and it did move from 565 all the way down to about 512, right here. So we actually got lucky because there's never skill here, but we did buy the low over a week ago Monday. We bought that Monday low. You should see that in your accounts. And our area of ownership is about 512, give or take a few pennies for each of you. And that was literally the low of the market. We have never looked back. The market has since rallied from the 512 low where we got in all the way up to today to 542. That's a 30-point gain from 512. I don't need to tell you that that's a 6% gain within a week. But why did we buy it there? Why did we wait? Very simple. Look at where our risk was at that time. Our risk at that time, algorithmically, was just a close somewhere below 500. Well, if I bought it at 512 and I'm willing to risk a close below 500, that means I'm risking about 12 points on my 512 that I purchased. 12 points is about 2.25%. That we can risk. So we buy the trade here. Now we're long, everyone. We have about a 2.5% risk where we know we have to get out. Doesn't mean we would lose exactly 2.5. We could have lost 3. Could have even lost 4 if the market just decides to destroy itself and open way lower. But either way, we were in a position to defend our price. Up here, I have no defense. Here, I have no defense. Believe it or not, there was no real defense on this market for a long time. That's why we're out. Now we have defense, which means we put on a position that we know that we can get out of comfortably and not hurt any individual portfolio. We have 6% in the trade with no pain. And those are large positions in most of your accounts, because if you own aggressive, balanced, or even conservative, you have anywhere between 20 and 30, maybe 33% exposure to the S&P, which means now you are close. Many of you that have those portfolios are very close to being 85 to 90% long. That's very long. That is a very bullish position for us. But that was only because risk reward allowed us to do that for you. So for those of you that are always wondering periodically why, when you put money into the stock market, you open up an account, you expect the money manager to put that money to work. Every pundit you see on CNBC or Fox Business in the morning or Bloomberg, all of them, they all come on just like me, a talking head, and they all talk their book. Their book is they're long. So they're always talking about this is a buying opportunity. It's a good stock. It has great fundamentals. And to be honest with you, that means nothing to me. And it really shouldn't mean anything to you. They're just talking heads, no better, no worse than me. The difference is we look at risk reward mathematically only. They don't. They're not concerned with your risk. They're going to own that portfolio whether the market went down to 512 or it went down to 412. They're going to own the market. And then they'll be offering the excuses. Well, there was the market that went down. It wasn't our fault. We had good picks. They were great fundamental stocks. They're still a good buy, 30% cheaper. We don't want to lose the 30%. We don't want to hold your hand that way. We have to hold your hand as the market goes up strongly and we're not making as much. When the market goes down, we really don't have to hold anybody's hands because everybody's nervous. They want to be in cash. So I just want you to understand there's two things going on. There's the psychology of the market. We all get that. But there's also risk reward. And fundamentally, I think all of us should hopefully agree that at the end of the day, what should dictate the performance in the way we put our portfolios to work is on risk and reward and nothing else. I don't think we have great picks. I don't care. If there was a symbol that traded horse manure and that symbol was mappable and we could apply machine learning to it and get predictors that made sense and we had an expectation of a positive return, we would put that money to work there in horse manure. And Archer Daniels Midland might be an example. So it's a company, of course, that does things like that, right? They sell farm seeds and equipment and the way a farmer be able to bring his crop to market. And one of the things they sell, of course, is nitrogen, which is the distillation of horse manure and other kinds of products that compose the compost into something that feeds our land. It still boils down to the risk versus the reward and how we want to navigate your portfolios. The last Monday was a prime example. It does make it easier for us at Flip to talk to you about this particular trade that wasn't on. But we saw literally from 565 to 512, we looked at a 10% correction that you guys didn't have to go through. And then we bought it and it's recovered literally 6% of the 10. Which way would you rather own it? And this isn't me taking a victory lap, folks. It is just the math. It's just the math. And we have to leave it at that. We either believe in the math, we believe in the technology to navigate the market, or we just buy, hold, and pray. And all of us know there is going to be a point where the market is not so robust. There won't always be a discount rate cut around the corner. There won't always be the next AI dream child, NVIDIA. There's always a bull market somewhere. I will agree with Mr. James Cramer on that. However, those are the same people that will endure 30, 40, and even 50% losses and then scream at the top of their lungs on TV that it shouldn't be that way. Because what are they? They don't get in and out of the market. They just hold forever and expect the market to always go up. And that's been a good plan for them up until it isn't. And that's why I wanted to take these first few minutes to go over this particular trade. There was our buy. Came in. I have to say, we got lucky. We bought the low. Our signal was generated on Friday. We knew the buy was coming. We were obviously on top of it. That's it. So for that, so we're going to stop here and we're going to go back and I'm going to share a different screen to go over the general markets because a lot's changed since then too.
Kelly, while you're doing that, just I know you said it's not a victory lap and it's just it is the math, but I mean, and it's not always going to work like that, right? Like we're not going to claim that we always get in at the exact bottom.
No way.
Again, it's like he just summed it up, but at the end of the day, everyone else buys and holds. Like if you want to do that, that's just fine. We're just not the spot for it. We don't want the roller coaster ride. You know, we want to take our stabs when there's opportunities and just, you know, be out of the market when things look dangerous would be my layman's terms way of explaining it. But you know, same results with a lot less risk is a win in my book. So,
well, we also, everybody at some level, there is a casino-like atmosphere around the stock market, just like going into a casino. When we're sitting down, if you're a good player and you know how to count cards in blackjack, or you know how to manage through the games that are available to you in a casino, then the people that tend to do the best are the ones that study and play the odds. Those are like the card counters, and of course the casinos don't like those. But at the end of the day, you can choose to be a buy and hold person and just sit there like you were a person gambling at a blackjack table, and you can let the house play the odds. And the house has the odds against you, and we all know that.
Right.
We're trying to say, here's a house where they don't have the odds against me, and we can do things to manage our monies much better than a casino.
Right.
But if you're a buy and hold person, I'm sorry, to me, that's kind of close to a casino because you just don't know. You just don't know. So let's go over to markets. Look, we've had I'll start by making these bars a little bigger for easier to read. Hopefully that's a little easier to read for everybody. And I'm going to zoom through them. Here was our correction. It was 3 awful days in the market where we had some serious moves down. The last 6 days have been up, recovering. About a 618 of the total loss on the of the Dow, which is a Fibonacci number. There may be a little resistance in this area here, but I'm not so sure I can be able to say, hey, this is the spot to sell the Dow based on the recovery we've had. Take a look at this S&P, which we were just looking at, very similar results. We've recovered a great deal of our all-time highs, but we're still about 5% off those highs. Here's the Russell. I thought this one was really an interesting move. This here is this is the NASDAQ. Sorry, let me get to the Russell here. Where's that Russell? IWM. I gotta find it. I don't have the Russell handy, but it's important. It was. I thought we'll stay away. I'll find the Russell in a little bit. The IWM. If you look closely here, we were to run a year-to-date chart. This is the year-to-date chart for the NASDAQ Composite. This was the beginning of the year. When we got down here on the NASDAQ, where we formed that low that Monday that we bought the S&P, do you realize at that time we were only up 2% in the year of the NASDAQ Composite? Just 2%. So for a year that seems like we've seen everything go sky high, for a very short instant, we were only up 2%. We're back up to be up about 7% on the NASDAQ Composite. But let's take a look at the NASDAQ itself here, and we see this kind of same thing. We were again about the same 2% on the NASDAQ 100, and then we had that rally. But look what the correction was. We moved from about 20,006 all the way down to about 17,000, call it 6, right in there. So we lost 3,000 points. On 20,000 points, that's 15% correction. None of us endured that. Nobody was down 15%. So this is the move that came down. None of us experienced any of that loss, and that's something I am proud of when we run portfolios, is to say, what was the risk like during times of duress? And ours was almost negligible. Let's keep an eye on some of the other things that have happened. Here was that spike in the VIX that everybody talked about on that Monday. People came into their offices in New York and saw the VIX at 65. That, by the way, was an all-time high print. Never had that before. And yes, it was a good sell if you had it. But what that was the unwinding of something called the carry trade, which is a trade between the Japanese yen and the Japanese stock market, Japanese interest rates versus US interest rates. That was an unwinding because the Nikkei on that same day lost 12% in one day. So we may have been down 3% in one day, but the Nikkei was down 12%. And that was, by the way, a slaughter. Next thing, let's look at the oil market real quick. Oh, no. I want to go through the Mag 7. There's so much to go through here, and then I'm going to kind of lump off. Look at Microsoft. We were trading around 5 or 470. We got all the way down to 390. I don't need to tell you that that's an 80-point correction on 470. That's almost a 20% drop. Microsoft has recovered a little bit, but damage has been done to the stock. It did make a new low. And for one instant, again, Microsoft was really only up about 3% on the year on that Monday low. Netflix kind of hung in there and is staying there, and Meta is the same. Look, they came down, but they're still, Meta is close to its all-time highs. Google had a bad day today, but Google, again, is another culprit. It has time. They're looking at breaking it up. That's the reason that's fallen. NVIDIA, what a rocket that was. It was from 140 all the way down to about 90 a share. That's $50. I don't know if anybody knows that, but if you take $50 off of 140, we're looking at a 35% correction occurred. Now, yes, granted, people made 300% on it this year. I sure wouldn't have want to been the guy that bought it up here, because his experience has been, hey, what happened to my 25, 30%? So this is the kind of thing the market did. Yes, it recovered. Luckily for them, luckily for all of us. But I don't like luck. I like risk reward. The oil markets, which we believe in highly, they had the same kind of thing. They fell off, and they're in a slanting movement. They're still paying their dividends. Oil remains high. This is the price of oil, essentially. Here's some of the items inside of our red oil portfolio. This is the XLE index. We've been in this market all year. It's paying a great dividend. Ownership of this varies from where we own, but keep in mind these dividends are paid and they're nice dividends of 71 cents a quarter. So that's $2.40 a year on a $90 stock. So that's about 4.5. ExxonMobil, guess what? I mean, look, it's close to its all-time highs here. And again, paying a great dividend. Here's our other ones. Energy Transfers hanging in there. We believe, I've been a big believer of this, to $22 a share. It's right there, just barely off its highs. All Plains a little more off of its highs, but I believe in this stock just the same. They're just competing pipelines. Here's a new issue that I'm looking at adding possibly into the red oil portfolio. It's a little bit different. It's a real estate. It doesn't belong in red oil, but it is a real estate ETF that does put together a very good dividend, and it's not tied to commercial real estate. It's tied to residential, which is important. The bank stocks, they're still hanging in there, doing well. Here's JP Morgan, Bank of America, fallen off its highs. It's the weaker of the bunch. Goldman is close to its all-time high here. Charles Schwab is taking it on the head. I follow it because it's a very good trade periodically. These are some of the other markets. Sallie Mae, they've fallen off, but I still believe in them on the margin. Here's CrowdStrike. I think we heard about this. This was that big outage that we saw in the nation a few weeks back when nobody could log into, say, their Amazon cloud. A lot of systems went down. So CrowdStrike, of course, is the gateway to protecting people's identities, and it got broken into, and they crashed the systems, killed the stock. I was personally a buyer around the 280. I did buy some more around the 225 area down here. I'm a believer that this stock could recover. I have no thought. It is not in any of our portfolios, but it's something I'm looking at to maybe create a different kind of portfolio of distressed stocks. So more to be said there. If somebody's interested, this is something to look at for people. We're going to look at AT&T real quick on the telecommunications, right at the highest highs we've seen in a long time. The last time we were here was literally January of 23, and we weren't there for long. Verizon is that's Tesla. Verizon, very similar. I like these telecommunications, especially if we have any kind of recession. I think there's room on the upside, and there's great dividends currently. 6.7, by the way, on Verizon. Okay, finally, I'm going to go to Bitcoin, all over the place, folks. On that Marvel Monday, we really had some low prints. The market has obviously recovered some, but Bitcoin is in the form of the IBIT. Bitcoin is still having its issues trying to get to those highs, and we have a declining pennant right now. My bet is for these kind of price levels, it's a 50-50 bet for higher or lower. I'm a long-term believer. Everybody knows that of the Bitcoin product. So I'm just going to remain long. I'm an investor in the BitFlip product. When we have momentum, I'll be in the market 100%. And when we don't have momentum, I'll be in the market 50%. And on that, Lee, I've blabbed for 30 minutes. Let's get to some questions.
Yeah, get some water too if you need it. That was a lot.
Sorry, everybody.
No, that's nothing to apologize for. I just meant there's a lot to cover.
There is today. Might as well throw the bonds in real quick.
Yeah, go ahead.
Forgot this. This is something we talk about every week. Can't miss it this week. Obviously, the reason for the Monday sell-off was this reason here. Interest rates literally plummeted for an instant on that same day. We did have some declining economic data that pretty much put the seal on the bag that the Fed will cut rates in the September meeting. A lot of people are now thinking there could be 50 basis points. I think during an election year, we can expect 25. But I also think that might bode well for the stock market, because you know what? The stock market and the bond market are going to say, where's my other 25 basis points? And that'll give them the incentive to remain long, saying, I'm waiting for the next interest rate cut. So the market loves to anticipate something good for it. and it will rally generally, and as long as it can see that opportunity. So that's one of the things that tell me that the S&P trade has probably got a little bit more legs. Hopefully we can get back to the old highs. Sorry, Lee, there you go.
Nothing to apologize for. Like I said, there's a lot to cover. Some weeks or maybe not weeks, some call it 2-week periods between these are more active than others. And like you said at the start, we did need to talk about the SPY for a bit, but that doesn't mean we should not talk about some other important things going on. So all good stuff. I think you've baffled everyone because we don't have many questions so far tonight.
Where do I give that gift card to?
Yeah, yourself, maybe.
I'll take it. I buy on Amazon almost every other day.
I grabbed a package right before I opened up this live stream, so I'm probably in the same boat. We do have one from Steven that is probably right up your alley. So Steven said, do you review and use intel from the financial/economic calendar for trading strategy, as economic events can have a direct effect on volatility, which may affect trading?
Go ahead. That's a very good question, and that's one that has been asked of me. Literally, don't take this wrong, but 30 years ago that was asked of me before they even had any real deep ideas of writing, at least at that time, algorithms to say, hey, we know what the economic calendar is. Maybe we should, try to maneuver our trades around the economic calendar, knowing we're going to get volatility as a result of some number that comes out. And those numbers come out constantly, and that's what drives the market. The answer to that is all the research says that we can't really anticipate the estimated value, what the expected value that we think a number is going to come out at, and then the actual value that it comes out at will determine that volatility. Every time years ago, and I will say it's been about 20 years since I've looked at that, literally at the beginning of the century, that's maybe even more than 20, where I found that with other people, by the way, helping, that if we were trying to time or anticipate an economic number, we couldn't either take advantage of a trend that might be existing into that number, which, by the way, is formed by the numbers themselves, right? Those numbers, as they come out, essentially create the trends that we're in various markets. And there was no identifiable data, at least when I looked at it a long time ago, to said, no, we can't build a system or a trading idea around that we found to be successful. Now, there was some individual symbols that it could be successful on, but it wasn't broad enough for us to be able to say, this is a way we could allocate capital in any large way. In other words, for us, when I did this, we're looking to allocate at least $50 to $100 million at something. Otherwise, it just doesn't have the capacity to put the money to work. Now, for most of us, we don't have $50 or $100 million, and you might be able to do some of that work at a smaller level, but it's a lot of effort, and it's better to just let the numbers be what they are and try to follow the trend of those numbers. So it's a great question, and I will lead you to this as a follow-up. There is something on dividends that you might be able to do that I have looked at, but we backburnered so many other things for the sake of changing our software, our appearance of our software, that we've sidelined a couple of things that I really like, which are, how about the dividends? Why should we own a dividend stock? Normally, I only want the dividend stock, and I want the dividend from it. I don't care about the movement. It can go sideways, but if I can get the dividend, that's great. Why wouldn't I say, hey, let's always buy it 2 days before the ex-dividend date and sell it 3 days, 4 days, 5 days after, and see if we can capture something around a dividend? That, I think, is a better place to explore. Better financial resources, I think, are spent there.
Cool. And to be honest, there might be others that are in my boat where they didn't fully understand the questions. Maybe give us an example of like something that would be on that economic calendar.
Well, for example, today we had CPI came out. CPI came out with a 0.1% increase, which is smaller than expected. In other words, inflation conceivably contracted a little bit. Year over year, it was 2.7. What the question was referring to is why not, knowing that we have this economic number coming out, how can we maybe trade knowing that number and make a not participate in the volatility, may in fact try to take advantage of the volatility of that number.
Sure.
So, which, again, those numbers are coming out, especially in the beginning of a month, beginning of a quarter, all the time. And there's so many of them that all the research that we did so many years ago, and I'm sure it continues today, has never proven anything around the numbers themselves.
Sure.
They more act collectively than they do individually.
Perfect. Yeah, I know, and it's not a direct correlation, and we don't need to make this you answering all my questions type AI circle, but I know sometimes people will ask about, say earnings or do we care about that? Or so anyway, I didn't know if it was at all correlated to that, because I would, and this is my opinion, I think when you're trading, that stuff matters more than when we're trying to, we're basically long-term, not necessarily holding these companies, because we will make trades, but we don't necessarily care about one day as much as someone who might be trading, a particular stock multiple times in a month.
Years ago, everybody, when I was at the University of Chicago, I was in the math department, but there was a professor there, an economics professor named Eugene Fama. He wrote a book called A Random Walk Down Wall Street. Some of you have probably heard of that. But what he ultimately came out with, and if you read it correctly, all the information is already inside the price. And he wrote that book in the 90s. Sorry, he wrote that in the 80s. And actually, I wasn't even in school. I was trying to get back. He did that after I had left. If all that information of the economic data that comes out, including today, was in the market, it was already in the price. That was in the 80s and 90s. At that time, it still took a couple of seconds for the numbers to come out and the market to really react and take hold. Today, all of that is anticipated by parsing programs run by hedge fund managers. They parse that data, and when it comes out, you'll notice it comes out in kind of a feed. It's released electronically, and it's been that way for a long time. And if you have a computer parser waiting for that release, it reads it and it sees the number. It could actually initiate a trade instantaneously. There's no way a company like Flip, or any company, unless you're Citadel or Virtu, that is able to act quick enough to buy the market or sell the market based on that information, because somebody else has already done that electronically, which reinforces what Fama's point was, which was it is a random walk. All data, as soon as it comes out in now microseconds, is instantly reflected in the price.
Yeah.
Which means it's just one of the reasons why we could never find trading around economic data, because it creates volatility. You have to be fast. We were able to do that, but at the same time, we still found no information in the noise. That's another conversation I can have with a person. I'll mention a name, Elwin Berlenkamp. Anybody want to Google that? You might. So he was the mathematician that I knew. He was with Jim Simons when Simons opened up Renaissance, and he believed there was information in the noise. I had an argument with him. How do I argue with the Berkeley professor that worked with Jim Simons? Who am I?
Cool. Well, I know we have a couple more questions to get to. This wasn't really a question, but thank you, Vanessa, for the nice words. You just said very good and informative. So, Vanessa, you're welcome. I'll take credit for Kelly. Joanna had a question, and Kelly, you ended, or not, I guess you brought back. It wasn't the last thing, but you talked about the IBIT. Correct me if I say anything incorrect here, but basically you were saying, where the IBIT was it was kind of 50-50, might go up, might go down. You obviously have conviction on crypto, or excuse me, more specifically Bitcoin itself. But she's basically asking if it's a good time to get in or not. As our disclaimer said, we can't tell you or give you advice on this sort of stuff. But Kelly, if you want to throw out your opinion, you're welcome to.
Absolutely. I mean, I am allowed to have an opinion, and that's why this is news and why we have a disclaimer. There is no doubt at some level that cryptocurrencies currently are a relative function of the stock market and the wealth effect. Remember this Monday low, the Monday low that the S&P was cratering in the morning, the one that we bought. Well, guess what was also cratering that morning? Bitcoin. Here's the price of the iShares Bitcoin. And let's move over to the Bitcoin itself. Here was Bitcoin itself, that same low on Monday. There was no volume there. It immediately traded up. But this is the way Bitcoin traded itself. So Bitcoin, take a look at this. And here's I'm going to go a little deeper into your question. Let me answer your question and tell you a reason why I kind of have a conviction here. I'm a believer in Bitcoin. So anytime I can see it cheaper, I kind of want to buy it. But right now, if you just look at it this way, it is forming a pennant, very similar to what I'm seeing a lot of other markets do, which is telling me it is really following the U.S. stock, well, the worldwide stock markets, really. And what I've noticed is that the only way Bitcoin really finds its own home is when it decouples completely from the prices of equities. The wealth effects creates and changes a lot of things. So I'll give you an example of the wealth effect and why it matters. And I'm going a little longer into your question because it's a simple question. Should you buy it or not? But there's more to it. At the end of the day, it's important to note this. When stock markets go down, that means the value of a person's account moves down. People want to if they give a loan out, say you want to buy your kid a house, and your child or someone you know, your mother-in-law, your mother, needs a loan to get a down payment. Well, people that have large stock accounts, they can go and get a margin loan. That feels very comfortable when the market's doing well and their stocks are up. But when those stocks go down, that means that margin loan looks a little tougher. Now, do I really want to give out a loan? I've just lost 10, 15% of the value of my portfolio. So I had, say I'm a lucky person, I had $2 million. I'm wealthy. I have some money. But I just lost, say 20%. I had a lot of tech stocks. Now I have 1.6 million. You don't feel the same with 1.6 giving out loans and taking out a margin loan as you did with 2 million, because you essentially lost the money you could have used for a loan if you just sold the stock. People think that way. I think that way. Same thing with Bitcoin. When other stocks are doing well, I feel comfortable owning that, saying, hey, even if I lose money, I'm okay because my stocks are doing so well. And I'm not going to buy as much Bitcoin as I do stocks. That's why they feel well. That's why they're coupled. People are ultimately looking at the value in their total wealth. And if the wealth is good because the stock market is up, guess what? They're going to be very likely to buy some extra Bitcoin. And that'll keep the price high. When the stock market goes down, it's going to go down. Bitcoin will never really get to where I think it'll be unless it decouples. The way that happens is when interest rates normalize. Right now, interest rates look like they're going to come down a little bit, and Bitcoin should be more a function of interest rates than it's stocks. It's only that way now because it's now the new thing. And we don't have to go and open up a Coinbase or Binance account to do it. We can go right in and do it by having a stock account, by buying this symbol here. And you might notice this chart looks a lot different. The percentage moves in this were much different than the percentage moves of the chart I had before. And what that's telling you also is there's an arbitrage going on. And there, in other words, there's a carry trade here too, which you got to be very aware of. And this, by the way, is more off its highs than even Bitcoin. So, but it'll also be more on its highs in a bull market. It's something we got to be very, very careful of. So I'll finalize and circle back to an answer. I'm a believer in Bitcoin. Anytime you get a decent dip, especially with using this product, it came out here because it's a brand new product, came out about $30 a share. You kind of want to say, hey, make your bet. If you can buy it at 30, you should own it. That's a great buy. But I would be more preference to buy it when it gets closer to these highs here in anticipation of new highs. This is very momentum-driven product. And when the momentum is up, you kind of want to be in it because you don't know how much momentum it could have on the way up. The way down seems to be almost always a function of the stock market. So there is my answer.
Perfect. And Kelly, I think that Phoenix Sun might have crashed your camera. We could hear you perfectly, but I did notice.
I know what to do. This is the...
While you do that, I'll answer the next question, let you get it going again. So Joanna had another question. In short, let's see, how do I explain this? So she's asking basically the difference between why her settled cash is not the same as the cash in each portfolio. And just as a reminder, this isn't necessarily a support related call, but just because almost all of you on here are probably iFlip users, settled cash is likely dividends, Joanna, that you've been paid for owning certain stocks during a dividend payment period. That is separate from any cash that might be inside of a portfolio. So like a few weeks back when we did not own the SPY, there was a lot of money in cash because inside the portfolio, but it doesn't show up in your settled cash because it's kind of accounted for, I guess you could say. It's in the Smartfolio, but again, settled cash is likely due to any dividends that you've been paid, and they're not supposed to necessarily add up. So Kelly, we got you back, which is awesome. This question's probably, you could give a better answer than I could. So Cody asked, does your system gear users towards more long-term or short-term stock strategies?
Longer term, of course.
Yep.
We're an investment platform, not a trading platform. However, we use techniques that were developed that generally were used for shorter term time series. So for example, we use daily data to help make our decisions along with a lot of fundamental data as well. However, a lot of these ideas that we use that seem long-term on a daily chart obviously are much shorter term if I were to use a 5-minute chart. So the great news is they work so much better algorithmically on daily data than they can work on 5-minute data. And so everything has, because of the way we set it, because we have IRAs and we have people's capital accounts, they're monies that are for retirement or trusts or other things. We are an investment account. Trading accounts are completely different. You can trade on our platform, but that's not really what's recommended. Yeah, you can buy a symbol today and you can sell it tomorrow, all of that. But an investment account is more of what we are, that is using sophisticated information to change the ownership of both the securities you have in it and when you own them and when you don't. So think of us more like a Fidelity or a Charles Schwab, but on steroids. We're doing things mathematically behind the scenes instead of ask a Schwab manager, ask a Fidelity fiduciary. We're allowing you to do the same things by just clicking a button. So yes, they're longer term.
Yep. And not to take your words out of context, but even though we're getting data daily, you already kind of said this, it doesn't mean we're making a trade every single day. Potentially you could, but we're not going to.
Correct.
So cool.
Well, the product isn't designed to trade.
Definitely not. So cool. Well, thank you for that. I'm not seeing any other questions. Last call for questions. I think I know who the winner is based on your response and the length to it, but you never know. Someone might trump it.
No, I mean, look, it was a simple question, but I think um, it's right. I hope you're thinking it was the Bitcoin question. So
I was not. You threw me for a loop there, but that was a good one as well.
yeah, I even though the Bitcoin question for asking it drove into something that I think is really important to understand for everyone. There is a relationship between Bitcoin and the stock market. And what that highlights is that when we're long Bitcoin, because now all of our portfolios, aggressive, balanced, and even conservative, have a small fraction of Bitcoin in them. The they are there because they are a function of the stocks that are also surrounding them, surrounding that small investment. So that deserves, a lot of a good requirement. The other, what was the one you thought, Lee?
I
I
thought it was
like.
going to be our first one. I didn't want to say who it was because
Yeah,
then
no, no. I want.
they'd be disappointed.
No, they better not be disappointed. I
They
like.
got the silver medal, and we only
You
care
get the
about
silver,
gold
and we
here.
can only pay on gold, man. Um, Bottom
So
line is, I like the Bitcoin question. Again, that should be the winner today because it
perfect.
allowed me to make a very important point.
Something you wanted to talk about. Awesome. So, Joanne, I know you know me, I know you, but we still do need you to send in your account number. You can either send us a screenshot of your homepage or just send us your account number and email that to mailbag@iflipinvest.com, and we will send you an email back just with how to redeem your Amazon gift card. So, congratulations for being our winner tonight. Kelly, do you have any last thoughts before we let everyone get on with the rest of their night?
Yeah, just one last thought, everyone. I'm expecting the S&P 500 to actually try to make a stab towards that old highs. And I want everybody to have an understanding that there is an opportunity or a chance that if we get there, it's going to sell the S&P. It is not going to hold it. So just
Yep.
keep that in mind, folks. This trade may not last that long. If the market returns down, we will give up our profit, but we've already guaranteed that our loss will pretty much, unless the AI has a different thought, will pretty much follow this line here, and our exit would be around 5 on the price of 500.5 would be approximately where we would get out of the S&P spider. Right now, that's where it is. If the market could continue higher, that price will advance, our risk will become less, and I could tell you, it will look for a profit take around the old highs.
Cool. Well, our next AI circle is exactly 2 weeks from today. So I'm sure we'll be talking about the SPY a lot again then, whether it continues to ride on up or if there's something new. So we'll see. But I think that's it for tonight. Thank you everyone for joining on. Kelly, thank you for the insights as
Thank
always.
you, everybody.
And
Thanks for attending. Thank you, Lee.
yeah, and we'll see you same time in 2 weeks from now. So have a great rest.